Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, March 11th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is U.S. exceptionalism dead? Our answers are, we're not pretend smart enough to ascertain whether the U.S. exceptionalism theme is dead only 9% into a correction in the S&P 500. What we are smart enough is to communicate the fact that the $24 trillion U.S. net international investment deficit more than doubled in the 5 years through the third quarter of 2024 and grew nearly sixfold since I started my career in 2009. That is a lot of unrealized gains for foreign investors to repatriate if they believe any of the following three things to no longer be true. Number one, the U.S. is exceptional from an economic perspective. Number two, the U.S. is exceptional from a policy perspective. And or number three, the U.S. is the global leader in AI development. The past couple of months have saddled weary investors with fresh, durable headwinds to evaluate regarding all three. All told, making a definitive conclusion regarding whether U.S. exceptionalism is dead or not at the current juncture requires a level of arrogance that we simply do not possess. What we do possess is an exceptional ability to properly contextualize the deluge of economic and policy data that will confirm or disconfirm the durability of the U.S. exceptionalism theme. And that ability continues to lead us in the direction of the death of the U.S. exceptionalism theme. Judging by consensus GDP sales and earnings forecasts, it will take months, if not quarters, worth of negative economic and earnings surprises for investor consensus to conclude U.S. exceptionalism is dead. There is a lot of market risk associated with that outcome, given where we were in the positioning cycle just a few long weeks ago. Transition to our 42 macro dashboard here. This one's regarding today's Bloomberg article on government data. It says, hi, Darius. I posited the question last week regarding changes this administration is making to the data you and so many others count on to be transparent. The article is a gift article, good for 7 days, So I put up the article and read it, and this is consistent with some of the commentary that Commerce Secretary Howard Lutnick talked about last week, in the sense that they are planning to, they've scrapped the Federal Economic Statistics Advisory Committee, which is sort of like a kind of a non-governmental organization that consults the government on the sampling and all the kind of wonky econometric stuff that you need to do to amalgamate and assess government data well. And so they're basically scrapping that. So it removes the level of oversight as it relates to who's watching, the U.S. government and the various U.S. government agencies, how they may change economic statistics, et cetera. And then Howard Lutnick essentially confirmed that they were going to be producing a economic statistic called GDP X government to sort of, kind of show the assumed resiliency of the private sector economy, X the impact of Doge and any other expenditure reductions that they legislate in the bill. So in the big beautiful bill. And so I think there's a few things that I think investors need to be aware of as it relates to this. One, as much as the Democrats are probably going to be very upset about this, every administration changes and tinkers with economic statistics. Most of it is done with, sort of a altruistic intent. It's not done maliciously. It's done to make the economic statistics that we in the financial markets and the private sector are relying on to make them better. An example of this is reclassifying how we scored productivity a couple of years ago, because obviously the tech sector has gotten so much bigger in the economy, and as a function of that, we just weren't necessarily, a lot of old age productivity metrics and how we sample productivity was a lot, kind of driven by the manufacturing sector, but obviously the services sector and the digital economy is much bigger driver of the U.S. economy now, with the manufacturing sector only representing 10% of GDP. So those are the kinds of tinkerings that we see. They reclassified income growth and savings last year. They obviously reclassify, the employment picture every year in the annual benchmark revisions and in the QECW revisions as well. They're always working towards trying to make their assessment of what's happening in the economy better. Now, with respect to scrapping the Federal Economic Statistics Advisory Agency, this sort of, my assumption is they're going to try to make the statistics better. If you want to put on some blue-colored glasses, you can assume that they're going to start to lie about the assumed resiliency of the economy, which is consistent with removing the impact of Doge from the GDP statistics. So I think there's a little bit of something for everybody on depending on what side of the aisle you are on as it relates to this. But in terms of how we're thinking about this, I'd say there's probably three key takeaways. One, again, if they do go down the path of lying about economic statistics, I'm pretty sure that every administration before them has lied about economic statistics in one form or another. I mean, obviously we've had so much progress on inflation, and it's within striking distance of 2%. Yet the entire electoral college map from coast to coast was red, and so obviously people felt like they were being lied to as it relates to inflation and the general resiliency of the economy. So that's number one. Number two, we already have GDP ex government. We already have real final sales to private domestic purchasers, and that's been growing at or above trend at around 3 to 3+% for the last 2 years, every quarter for the last 2 years. So they obviously had a very resilient economy, ex government impact. And then finally, what was the third point? I'm getting old. Oh yeah, if we did see one of the reasons they're probably removing the GDP impact from moving the government impact from GDP is that they ultimately know that, hey, if we make the kinds of cuts that they're talking about making, and then Elon Musk was on Fox News with Larry Kudlow either yesterday or over the weekend, he basically confirmed our estimate, which was way higher than what Wall Street is currently considering, which is we think they're going to get to $500 billion to $1 trillion of cuts from the annual federal expenditures, from the annual budget. Most people on Wall Street are talking in the couple hundred, $300 billion range. Elon Musk and I, which is Elon Musk arriving at the conclusion that I arrived at months before he did, even though he's the one running the Doge program, we said 4 or 5 months ago, or 3 or 4 months ago, 4 months ago, that they're probably only going to get to 500 billion to $1 trillion. At the time, I got roasted and dragged all over Twitter by the horny Elon Musk fan club because there was a $2 trillion number out there. And I said, there's no chance they get to $2 trillion. And here are all the 30 reasons why. But the conclusion of our analysis was that they were probably going to get to 500 billion to $1 trillion. If they take a 500 billion to $1 trillion chainsaw out of annual federal government expenditures, that is going to cause a significant hit to economic growth. There will be spillover effects in terms of the private sector economy. If you think about the companies that sell things to the government, ex SpaceX, because we know SpaceX contracts are going to go up as a function of all this. And that's neither here nor there. It's not a political comment. We just know that it's true. It is what it is. But so there will be a significant hit to economic activity. And it's not necessarily like I said in the executive summary, you don't see it anywhere in GDP estimates. You don't see it anywhere in earnings estimates. You don't see it anywhere in consensus sales estimates. And obviously at the all-time high in the SPY just a few long weeks ago, 2 or 3 weeks ago, we were signaling a high risk of a crash in risk assets in terms of our positioning model. So people were not positioned for any sort of significant erosion of the U.S. exceptionalism theme, which may be aided and abetted by either separating government from GDP statistics or just completely outright lying to the public about economic activity. So I don't know what they're going to do. I'm not going to pretend like I know what they're going to do, but I will be monitoring this as closely as anybody. Don't forget, I think I'm the only person crazy enough to analyze every single significant economic statistic that comes out of every major economy every single day. I mean, literally like dozens of statistics every single day. I analyze them in rate of change terms because that gives me the best opportunity to spot critical inflections in the key macro cycles that matter to the market better than everyone else: growth, inflation, liquidity, monetary policy, fiscal policy. If you're doing the bean counting, just like Elon Musk is doing with Doge, you can spot the changes weeks, months, sometimes even quarters ahead of consensus. And that's what I get paid to do. And I'm really grateful for our clients who are paying me to do that. So we'll wrap it up there. Darius Dell here presenting our macro minute for, is it Tuesday? Godly, it's been a long week already. Tuesday, March 11th, 2025. Best of luck out there. We'll catch you back here tomorrow. Cheers.